Scott. We appreciate the opportunity to be here. As she mentioned, my name is Wes Wilkes. I'm the Business Development and Marketing Vice President at CoreCredit Union. I've been with Core now for 8 years. And prior to being with Core, I was actually here at Robbins Federal Credit Union here in Swainsboro. I spent about 9.5 years there as the branch manager. During that time, I started noticing things some trends that went on with people's finances and how people's finances had a bearing on their life and how they were, where they lived, things they were able to do, things they were able to accomplish. The biggest thing that I started to realize is it wasn't so much about the amount of money they made, but it's about the choices that they made, specifically when it comes to your budget. With things that's going on now with what we've experienced with COVID and the pandemic, we've started seeing a lot of things change, especially, I'm sure if you guys have been to the grocery store lately, you've probably noticed a big difference in your grocery bill. As you go out, you start looking at your gas prices, things of that nature. So as we go into this class, I'm really excited about it because I think there's probably never a greater time to have a better understanding of your budget and about your finances as well. When we developed this class, one of the things that we wanted to do was have it be interactive. So I encourage you as we go through these slides, if there's something that you're thinking about, something that you have a question about, please feel free to stop me because I don't want to just give a presentation. I really want it to be interactive and you guys be able to get something out of it because there's a lot of material here. We're basically just covering the surface of it. So if you have questions, I'd love for you to ask. If you don't feel comfortable asking in the beginning, if you'll stop me after the class, I'll be happy to answer try to answer those one-on-one. So let's get started. So where do we start? The biggest thing we want to do is we have to recognize the need for a change. And as I mentioned, our purchasing power is going down daily as we look at things. I know in the finance industry, as a business owner, as we look around, things are costing us more today than they cost us even a year ago. In some cases, less than a week ago. We just never know what it's going to cost the next time we have to purchase. So we have to recognize the need for a change. One of the biggest things that we want to do is be able to manage our debt. Notice earlier I said that it really didn't matter how much money that you made, it was how well you managed the money that you had. So we need to manage that debt. And we're going to talk about some of those things specifically. And I hope that you got a printout of the comprehensive spending plan. I don't know that you have one. We'll make sure we get you one. But this comprehensive spending plan is basically how to create a budget for you. And that's going to be really big because that makes all the difference in how you're able to manage your money. We'll talk about some different things as we go through that. But managing your money starts with a budget. And what I noticed is in the finance industry is the people who were not having trouble with their finances were people who had budgets. People who were managing their budget, the better they managed their budget, the better their finances were. So it made a really big difference. The people who weren't managing their finances, a lot of times they come in, they had overdrafts on their accounts, things of that nature. First thing we'd ask them, do you have a budget? Do you have, where's your check register? They didn't have any of those things. I know now, we use debit cards more often than we use checks, but we still need to be writing those things down so that we can keep track of our balances. We want to talk a little bit about managing your credit and then how, basically planning for the future, just what that means and what bearing it has on us. So as we go into this, there's one thing that I want you to think about. Your finances have a multi-generational effect. Your finances have a multi-generational effect. Think about this. The choices that your parents made with their finances had a bearing on your child care, has a bearing on where you live now, the type of schools that you went to, the neighborhood you lived in, and it's going to have an effect on the future generations. So your finances and how you manage those have a multi-generational effect. And I think that's very important to think about as we go into this. So let's dive a little deeper. Let's talk about some of the obstacles, and this is one of the biggest things is our society's attitude towards debt. We were in a board meeting last night, and we were talking to one of our board members, and he works for an auto dealership. I remember when I was doing finance, someone that financed something over 60 months was kind of getting a longer term. It just didn't seem as good of an idea. They were paying higher interest rates, maybe not could quite afford the car that they wanted, but if they could do it for 72 months, well, now that's turned to 84 months. 84 months. So 72 months has kind of become the norm now, and 84 months is becoming a bit of a stretch. So that's where we are as a society towards debt. We're more open to have debt, even though things are changing, especially now with inflation. We're spending too much, we're not saving enough, too much debt, we have too much debt, and we're not planning for the future. Now, I want to point something out here. There's a difference between spending too much and too much debt. Can somebody tell me the difference? So when you think about debt, right, we're thinking about maybe auto loans, bank loans, something that you finance, right? Well, when we say we're spending too much, that probably means we don't have a budget. And we could have too many loans, but we could take some of the assets that we borrowed against or whatever, and we could sell those and we can get rid of those debts, right? But they still may not control our spending habits. So there's a difference there. There's a difference in somebody who spends too much and somebody just is overburdened with debt. It's a lot easier to get out of the overburden with debt because you can get rid of those items, you can sell those items and get out of that. Spending too much is changing the behavior. So what are some of the financial attitudes? We don't want to have childlike behaviors as an adult. Our spending patterns can't be the same now as they were when we were a child. I remember when I was a child, I had a job, I cut grass, and I would save my money, and I had this, this item that I wanted to buy. And I would save just enough to buy it, right? And I had just enough. As soon as I had enough money to buy it, what did I do? I went out and bought it, right? We can't do that now as adults. We have to save beyond that because we have to plan for the future. We have to plan for, unexpected expenses that come along. So we can't have those childlike behaviors as we become adults. Another thing is, as our parents could have exhibited poor behaviors, they also could have exhibited good behaviors, but they never taught us those good behaviors. So this is where some of our attitudes towards finance goes, internal and external. Maybe they failed to educate us. I've seen, people who had a situation where their parents did not manage their money well, and they use that as a, stepping stone for them to get out of that. They saw what was going on, they didn't want to be there, and they use that as a driving force to get away from those behaviors. But I've also seen people who had really good behaviors that didn't talk about to their children, and then their children come along and their children don't really know how to manage the finances, even though the parents did a really good job. So this is where some of this comes from. Everybody has a cell phone, right? Anything that we want is on that cell phone, right? We can actually access our bank, we can access any accounts that we have, but we also can pick up a phone and we can purchase something right away. This instant gratification that we have is shifting society's attitude towards borrowing. I mean, it gives us, if we don't have it, we want it, we can get it, right? There's online banks now, so if you want to go online and you want to get a loan, you can go online and get a loan. Mitchell and I were just talking about the fact that you can get your student loans done online now. You don't have to come into the office anymore. So things are getting easier for us to borrow on a daily basis, and that's where some of our instant gratification kind of gets in our way. We're encouraged to buy now and pay later. So think about how can you go to a merchant and you go up to the counter and what do they offer you?
Credit card.
A credit card, right? But you had the cash to buy it. You went in there with the intent to buy it. But they're telling us, hey, it's okay, you don't have to buy it. You can put it on the card today and we'll send you a bill in the mail, 20 days from now and you can just pay it. So, these are where these attitudes become a bad habit for us or bad things that kind of creep into our life is how do we stop managing our finances. Lenders, you're not going to hear that very often. We can be part of the problem. And you say, well, we come to you and we trust you, so how are you part of the problem? But the thing is, if you don't have a budget, we don't actually see what your spending habits are. And we talked about those spending habits earlier where you're spending too much. I can see your debts that you have on your credit report that you borrowed against, but I can't see your spending habits. So when I look at your debt ratios, I can say, well, your debt ratios look fine based on the debt that you have borrowed. But I don't know what your spending habits are based on what your income is. So it's very important that you have a budget and you understand what you can afford when you come in to purchase an auto loan or you get a home loan or whatever. You can't always depend on the financial institution to tell you what you can afford. So I really want to drive that home because I know, that's what we're looked at as, but we can also cause problems because we don't know what your spending habits are. So it's very important to have a budget and understand what your spending habits are. So let's talk a little bit about the money cycles. There's 4 money cycles that you're gonna find yourself in one of these 4 money cycles, no matter who's in here. So the first money cycle is earn, spend, earn, spend. What is someone doing here? They're paycheck to paycheck, right? So how is that different from the second one? We got to earn, spend, borrow, spend. What are they doing there?
They save a little bit of theirs, then they'll get the money.
Well, there's no savings there, right?
Well, they spend it, then want some more.
They spend it, they want some more, right?
Yeah.
Right?
Yeah.
So basically, they're living beyond their means, right? This is somebody who doesn't have, a budget. This is somebody who says, hey, I need to buy this. When the money runs out, I've got to borrow it because I still got to have these other things.
They're hoping the car does right now.
Absolutely. And they're probably buying more of a car than they need. We see a lot of times that someone wants to come in and buy a used Mercedes, and they probably would be better off buying a newer, domestic or foreign vehicle that they can afford the repairs on. But we see them, they want to buy, the Mercedes, and then they find out that, a $500 repair on the domestic car is a $2,000 repair on, the Mercedes. And then they can't pay for it, for the repair, so the car can't get to work, and now they can't get to work, they don't have a job, and it just becomes a vicious cycle. So it's very important to understand what you can afford. And so we definitely don't want to live beyond our lifestyle, or establish a lifestyle we can't maintain. Earn, spend, save. What's wrong with this?
We're
pretty good, right?
We're saving.
So we're spending before we're saving, right? I had someone ask me in a class, how do you save before you spend? Or how do you spend before you save? What's going on there? When you create your budget, you have to have in your budget money that you're saving for the future, for future plans, for future unexpected expenses that may come along. All of our expenses don't happen every month, right? We have things that come along like insurance for our car, insurance for our home. Those things don't actually are not paid once a month. So we may pay those once a year, we may pay them every 6 months. But as we create a budget, we have to, calculate that into our monthly savings, and we have to set that money aside as well, so that when we get to that point that we have to pay for it, that the money is available to us, and we're not having to go borrow it so that we can get there. So this is definitely someone who's trying to save, but they're not doing it often enough. They're spending all the money that they have on the things that they want, and then what's left over, they put in savings. This is actually the hardest cycle to get out of. Wouldn't necessarily think so, but people think they're doing the right thing because they are starting to save. So we spin it around a little bit, and we earn, save, spend. Good behavior?
Yeah.
Absolutely. We begin to put savings as a priority at this point. This is where I encourage you to try to go to. Again, when you create your budget, you may find out that you don't have $20 to save. And that may not seem very significant to you, but I can tell you that I've seen people who had no money in their accounts in their 40s and 50s. We worked with them to put a budget, and when they got $500 in their account, you would have thought they won the lottery. It changes their lifestyle. It changes their mental health. It changes their behaviors. It's amazing how it transforms someone's life. And I just encourage you to work on that budget, because I can't tell you anything more about it. It's probably the most important thing you can do. So as we're talking a little bit about budgeting, how do you control some of the expenses? This is really important right now because, again, things are costing more and more each day. So when we look at housing, we have a lot of questions about should I own or should I rent? Is there a right answer to that? Why?
It depends on the company we live in.
Yeah, it does. It depends on the situation. So maybe, you've got a professor who comes in here, right? And they're only going to be here for 2 years. They don't want to, upkeep a loan. They don't want to have to deal with the upkeep on a house, things of that nature. It may be best for them to rent, right? Maybe you like going on a lot of vacations. You don't want to have to keep up the house. You don't want to have to pay the taxes and the insurance and all those kind of things. And you prefer to live in a condo or something like that, where they're going to take care of a lot of those things. So there's no right or wrong answer to this. It's just a matter that you need to look at your situation and decide how your situation applies. Cost sharing, get a roommate. Examine your utility costs. Again, restrain your choices. You know, is it a domestic car? Is it, you know, a cheaper foreign car? Or is it Mercedes? You know, maybe we don't need 3,000 square foot. Maybe we only need 1,500 square foot. You know, we don't have to keep up with the Joneses, so to speak. Transportation, that's 1/5 of the U.S. household budget. 1/5. Again, we talked about making the right buy. I think, again, that's very important, very important. Understanding pricing. A lot of times people go into the dealer and you know, you get a value of a vehicle, and then before you know it, you've got a warranty added onto it. You've got gap, which is basically saying that if you owe more than the vehicle's worth, then you total the vehicle, they're going to pay the difference. A lot of times this happens when you trade often and you have negative equity in the vehicle. So gap can be important, but at the same time, it can run up the cost dramatically compared to what it may cost with a financial institution. I think, Jim, ours, what, $4.95 for gap? Is that right?
Not 100% sure.
I believe it's around $4.95. Typical dealer's about $1,500 for the same product. And that's $1,000 that you're not getting anything different for. It's the same exact thing. So, you know, I'm not advocating that you come to us. What I'm saying is you need to check with your financial institution, because most financial institutions offer gap, they offer warranties, things of that nature. Now we're into a lot more than just, you know, financing vehicles. So definitely take a look at that. Warranties can cost you, you know, $1,500, $2,000 with us. It can cost you $4,000 at a dealer. Same protection. So it's just some things to think about as you're spending money and as you're looking to buy new vehicles. Insurance. Who in here comparison shops your insurance? Good for you.
I hate these people. I mean, we are in a house, and my father passed away, so we moved to town. And this house insurance stuff has about made me lose my religion.
Absolutely.
I mean, it's crazy of how it is. And when you start trying to shop around, you know, until you get somebody who gives you the honest answer. I mean, it's the same thing with car, you know, medical, you know, all the other. I mean, my brother's an insurance person. I don't hate him, but he doesn't sell house insurance. But insurance, that's one thing that I can tell you that people really, really should shop around for, because you will be very shocked at how. I mean, especially if you combine. If you do your house and your car, it's cheaper than just doing your house here and your car over here at Geico or whatever. I mean,
it definitely can be. She makes a very good point. It's very important to price shop. I can tell you the last time I price shop, I saved $1,500 a year. $1,500. The weird part is this time I didn't group them together. I had to get insurance for my house in one place and my car in another place, but it was actually cheaper than bundling them somewhere else. So you just never know. I mean, it seems like you may save, but it's important to comparison shop. I mean, $1,500 makes a pretty good vacation. You know, where can you spend that money elsewhere? Where can you save that money or put that money towards something else? Sometimes I think it's a curse to have that mindset all the time, but that's what I'm always looking for is, if I'm able to save this money, you know, how do I apply it to something else to get myself in a better financial position, or you know, what do I need to buy over here to you know, secure my future and those kind of things. So I'm always, you know, working on those things, but I can definitely tell you that just shopping your insurance is really important. It makes a big difference. Your deductibles, you know, if you can afford, especially as you get into creating a budget, if you can afford to raise your deductible from a $500 deductible to a $1,000 deductible, you'd be really surprised at how much your insurance will change. Very often, I mean, I hope I don't have a wreck today, but I don't know that I've had very many claims that I've had to actually pay out. So I'm taking a little bit of risk by having a higher deductible, but I'm saving a lot of money on the other side, because the money that I'm saving is the difference in what that deductible is costing me, especially over time. So just some different things to think about as you approach that. Telecommunications, this is always fun for me, because the postpaid versus the prepaid plans, there's a lot of companies out there now that you can buy a phone from, and then you're able to get a lot less expensive cell phone plan with. Quite honestly, I've probably been with straight talk for close to 20 years now. I pay $45 a month, unlimited. You know, my coverage, you ask, you say, well, maybe you don't have as good a coverage. Well, my coverage is actually a Verizon and some other carriers combination. So I actually have better, I have two phones. One's a work phone that's a Verizon phone, and the other one's my personal phone. My personal phone has better coverage than my work phone, who's only Verizon. And I pay less each month. So just some things to think about that's out there. There's a lot of opportunities to be able to save some money. You look at your utilities. You can adjust your thermostat by 2 degrees, and you can save 10% on your energy bill. There's a lot of things out there now. I mean, my business, I've installed all the programmable thermostats. You'd be surprised how much it's leveled out my energy bill in my business just by installing the thermostats. So it's a great way to save, especially if you're not there. Do you care if it's cool there when you're not there? I mean, you can really cut the units back. I mean, like my house, it knows I'm not home, so the units are cut back. It knows what time I'm coming home. It's gonna cool it back down, and I'll never know that it was warm. But it's a great way to save energy. So just some things to think about. Any questions on any of those? So if you're in a relationship, right? We all know this is a big cause of divorce, a lot of cause of headaches, a lot of heartache at night, maybe a lot of late night staying up trying to figure out what to do. But I want you to think about maybe where some of this comes from. We talked earlier about our parents and some of their behaviors, right? It's the things that we see in society that has a big influence on how we react to things. So in the first situation, we're going to take a traditional couple here, and the male in the relationship has seen his father manage the finances. Okay? And it's on the left side. So the wife of the situation has seen her her father manage the finances as well. So in their relationship, who do you think they're going to look to manage the finances? The male, right? Exactly. So what happens in the second situation?
You think they should be.
Sorry. What's that?
It's big conflict. Fine, conflict.
There could be conflict, right? There could be conflict. It seems kind of simple, right? But it's what you know. It's what you grew up knowing. And it's what you begin to expect from someone else. Right?
Having control over the purse strings is also creates a power differential. And so, you know, it's a big factor, you know, having control over resources. In relationships, or if you watch Animal Planet, you know, if everybody's happy with it and feels comfortable with it, it's fine. But you know, like you said, it's a huge area for conflict for a lot of reasons. A lot of times, you know, the person that holds the purse strings holds a certain type of power. And, you know, my mother, you know, my dad managed the finances in my family. They always managed them, you know, very tight, you know, very prudent people. But she worked full time and made, you know, good money, and, you know, always had to grovel for $30 to buy a pair of shoes, you know. And, you know, not in an ugly way, but she always had to ask, and he had to thoughtfully consider it. You know, she didn't spend that much, you know, and I looked at that, and now that I'm a very grown woman, turning 60, but I'm married, you know, for several years now after all the young years screw-ups, and I'm married to a very good man, and our finances are not married, and I'm very happy about that.
Well, you bring up an interesting point, because I saw very similar. I grew up very similar. You know, my father managed the finances. I'll share this with you. But my mother didn't necessarily work. So, you know, he would put money in the account. He would have money budgeted out for paying the bills. And if she went and bought something, well, it messed up that budget because that wasn't part of the budget. One of the things I will tell you about a budget as we get a little further into that, is you have to have fund money in your budget. Okay? You have to have fund money. Whether fund money is getting your nails done, or, you know, going on trips, or it's going out with girls, or going out with guys, or it's going to, you know, sports, whatever the case is, you have to have some fun in there. Think about it like a diet, okay? If you go on a diet, and your friends eat the cheeseburger, what do you want? You want a cheeseburger, right? So every now and then you gotta have a cheeseburger, or you're gonna get off that diet, because you're gonna get the cheeseburger either way, right? So you can't create a budget to the point that it's so tight that you can't go out and enjoy yourself. You can't enjoy living, you can't enjoy those things. And that's kind of where my parents were, is they would go out and do things, but it's all budgeted to the point that if you bought something that was outside the budget, it created an issue. So to further
It's a
that.
drag when you can never, you know, everything's done, well, we can't afford it.
Right, so to, you know, go a little further, me and my wife are not managed our finance, we have independent finances. She has her own accounts, I have my own accounts, we manage things in the household, she pays certain bills, I pay certain bills, we discuss those things, she has her own budget, I have my own budget.
It's understood.
But it's understood, yeah, I mean, we've had those conversations, and I think the important part of that is you do have those conversations, because we know what the expectations are. You know, again, if she wasn't paying her bills, things would change a lot. If I wasn't paying my bills, things would change a lot for her. So, you know, we have to have that mutual understanding and respect and trust of each other that we're going to take care of those things for the household. But it can create problems, because problems can be created from our societal, you know, things we learn in society. So in this case, yes, both parties are going to grow up the expectation that they should manage the finances. So what happens in the third situation?
They're looking to each other.
Nobody wants to do it, right?
They're like,
You know, because they're looking to the other person. Now, you know, this could be one of those situations where they come together too. You know, where both parties are saying, hey, I think you should manage them, I think you should manage them, we have some communication and things work out. Just the biggest part of this that I want you to see is don't have expectations of someone else. Have a conversation with them of your significant other. Have conversations with them about what's going on with your finances and iron that out so that it works for both of them. So we want to, you know, as we talk about the comprehensive spending plan, which is basically your budget, the first thing you're going to do is you're going to gather all your personal financial information. So what I mean by that is you're going to gather up all your bills and all your income. That's not just your paycheck. That's not just your loans that you have out there. We have other expenses that go along with that. We need to make sure that we're accounting for. I mentioned insurance earlier, taxes. We may get tax refunds. What do we do with that? You know, in the financial industry, unfortunately, I've seen a lot of people take that tax money and go spend it on something. It's kind of frivolous. You know, the money's gone within a couple of weeks, and you wonder where that money was, but it's gone because we've spent it on things that we didn't really plan for. We had some extra income. What I've always encouraged people to do is use that extra money to pay off things. You know, use that to pay off debt that you have. Use that for savings. I'm not telling you can't use it all, or you shouldn't use all of it or have a little fun with some of it, but at the same time, we want to make sure that we're trying to pay things off, we're trying to take care of things. Maybe we're setting some money aside for those unexpected expenses that we haven't had money for before. So some of those things are changing, especially with some of the things that's changing with our government. You know, they're giving an earned child credit now that some people are getting in the mail, a couple $100 every month. Well, when you get to the end of the year, that tax credit that you were getting, you're not going to get now unless some things change. So that, you know, a couple $1,000s that you were getting at the end of the year, if there was a credit, well, you've already gotten that money now. So it's going to have a big bearing come tax season that I think a lot of people are not expecting to happen, but it's going to be there. So we want to make sure we get all our income together. We want to establish some clear goals and objectives. We want to have those conversations with our significant others. If we don't have significant others, we need to decide where we want to be and how we're going to get there. You know, I read a great book. It's called Visioneering. But one of the things in it that really stands out to me is it says that visions evoke emotions. So if you can't see yourself there, emotionally, you can't get yourself there. You can't motivate yourself to be there. You have to see yourself in that moment to push yourself to that place. Visions evoke emotions. So, visualize yourself being there. Analyze the information. Make sure the information is correct. Then you're going to put it into the three-step spending plan, which make sure that we get some of those out for you so that you have those. But basically, this is where you're going to go in and create your own budget. This is going to ask you all the expenses you have, all the income you have. It's pretty comprehensive in the beginning of the things that it asks for. If there's something extra, you can definitely, there's some lines there to put it on there. But one of the things that I would encourage you to do is on the bottom of the first page, there's a point in there that has savings. And I encourage you to go in there and write that in the beginning. Think about where you want to be, how you want to get there, and start thinking about how you start saving. Because we want to be in that 4 cycle, right? We want to earn, save, spend. And that's how we're going to get there. You're going to implement your plan. But now here's the thing about a budget. A budget is a living document. What do I mean by that? It changes, right? So how does it change?
You lose a job.
Lose a job, gain a job, get a pay raise, right? Maybe we buy a new car, maybe we buy a new house.
Cost of living.
Cost of living, yeah, cost of living is changing right now.
Get a new
So
president.
it's a great time to go back to,
No, I mean, seriously.
well, it's
prices
changed,
have gone up.
obviously.
Yeah, that's not a political
Yeah.
statement, but I mean, the administration has changed, their priorities have changed. What they think government should do is changed. So
Right. No, and you're right about that. Right. Just want to make sure that's where you're going.
I'm not trying to be ugly, it's just a fact.
But we do have a different administration. Different administrations have different priorities, and as that, it has an effect on everyone. It really does. So, very important there, especially with the inflation. It's a great time to go back and monitor your budget on a more regular basis because the price of things are changing. In the beginning, if you haven't had a budget up to this point, what I would encourage you doing is going in and looking at your budget maybe every 2 weeks. Saying, am I in line with what I said I can spend? Am I in line with what I am spending? As you get comfortable with that, you can move it out to longer periods, unless things change. But anytime something changes, you need to change your budget as well. So just keep that in mind. Any questions about that? I know you don't have the sheet in front of you. I wish you did. I apologize for you guys not having it. We will get it for you.
How do you know when is the right time to make a purchase? Like so far as when you're budgeting and you have this really big purchase you want, but you notice those changes coming. So you just put that to the side and then.
Yeah, you're going to plan for it, Maybe it's you feel like, hey, I can afford this if I pay off these things. So you're going to start working on paying those things off, and maybe I start saving a little extra, till I can get to that point. But yeah, there is things coming. I mean, most of us have a car. They have a car, tires wear out, right? You got to put tires on the car. $500 to $1,000 is easy money nowadays for a set of tires. So, how do we plan for those? We have to start putting that money back. We know those things are going to happen for us. Maybe it's a great time that, if you're getting a tax refund, that you set some of that tax refund aside and say, this is some of my rainy day money for those unexpected expenses, or maybe expected expenses like your tire. If you have a house, what if your AC unit goes out? Right? 5 to 10,000 easy. So where does that money come from? And it's those kind of things we have to plan for, because it's going to happen. Just
You mentioned, especially to her or whoever, when you're wanting to pay things off, how to prioritize and what to pay off first.
Yes.
That really helps.
Absolutely. So there's something called, and it's easy, everybody's got a phone, we talked about that, instant gratification. There's something called a snowball calculator. Okay. So basically what it does is you go in and you put in all your finances, everything that you owe, you put in all your interest rates, you put in your minimum payment that they require, and then you put in any extra money that you have. So this is where you got your budget, you've got extra money in your budget that you can use towards something. And it asks, do you have any of that extra money? But that snowball calculator will tell you the fastest way to pay off all your debt. It's a really great tool. It's free. That answer your question?
Yeah, like paying your smallest loan
It's
payments
not always
were.
necessarily your smallest, sometimes it has a lot to do with the interest rates
Yeah.
and what you can afford to pay extra, but then, once you pay one item off, it tells you to take that money and put it on in addition to another item, and it basically, gives you a plan to be able to pay off your debts.
And so, like, when you mention debt, is that kind of in the areas of when you have like this bigger bill versus this smaller bill? And it's like, if you can get this bill paid to a certain point and it becomes smaller, that's actually like kind of like money saving you in those upcoming months?
It could be, yes.
Okay.
Now, when you say bill, I think bill as like a utility bill.
Yeah,
When debt, I think about like a loan. So
Okay.
we're talking about loan.
yeah, something like in those areas, like a small loan that you can pay off of your upcoming checks, like you paid off 2 months versus those 6 months that they give you, then you can be saving that money for.
Absolutely, and that calculator will give you the best way to do it.
Okay.
Any other questions about that? So let's talk a little bit about credit. Okay. You guys know what goes into a credit score? Now?
Yes, now.
We're going to talk a little more about it. We'll actually get into the percentages of what drives your score, where it comes from, what you can do to actually repair it, how to get a copy of your credit report, how much it costs to have bad credit. I'll give you an example of someone that I actually dealt with when I was at Robbins, and it's a true analysis of what it actually costs to have bad debt. And I just want you guys to see that because I think it's very powerful when you think about how much money you're spending extra just to have bad credit, because you have bad credit. And I want you guys to see that. So, understand your credit score. Your credit score comes from the Fair Isaac Corporation. The range is from 300 to 850. One thing that I want to point out there, Bob, I don't know if you can see this or not, but it says the credit score is designed to predict the risk of someone becoming seriously delinquent over the what? Months, right? Not minutes, months, right? So understand, there is no instant gratification in your credit report or in your credit score. I'm going to say that again. There is no instant gratification here. This is a long-term effort that you have to put in and you dedicate yourself to making sure that you're taking care of your credit. And we'll explain why, or you'll see why later when we start talking about how much it actually costs to have bad credit. So let's get into what the percentages are. So 35% of your payment history. Are you making payments on time? 30% is your credit utilization. This is how well you're using your credit. This is basically what they're doing is they're looking at your credit cards and they're saying, what is the limit on your credit card versus what's the balance? Now, right now, you want to be under 50%. So if you got a $1,000 limit, you want to have a $500 or less balance. Does that make sense? If it's above that, it's saying that you're not able to manage your credit very well. You're having to borrow more often, and that's going to lower your credit score. How long your accounts have been established? 15%. So if it's a new account, it's going to bring your score down. If you've had an account over a period of time, it's going to help boost your score. New debts. This is any time that you're getting a new loan or you're out shopping for new loans. One of the things that we like to talk about here is if you go into an auto dealership, and I'm not picking on auto dealers, but this is the things that happen. If you go into an auto dealership, one of the first things they ask you for is your social security number. Why? They want to pull your credit, right? So how many times do you think they pull your credit?
3, 6.
Maybe 6. They basically go out and they shop your credit to other financial institutions. And in doing that, every time it's shopped, your score is going down. So if you decide not to buy, and basically, so here, I'll give you a little insight on a dealer. So a dealer says that he shops your rate, or she shops your rate, and they see that they can get 2.5% from their company. But they come to you and they say, well, the best rate I can get is 3%, or 3.5%. The dealer makes the difference in what the financial institution charges and what you're willing to pay. So that rate is a lot of times negotiable. When you think it's not negotiable, it's negotiable. And the dealer is making the difference, or the finance guy is making the difference in that. When you go to a financial institution, we're not doing that. We have a sheet, look at your credit score, we're going to decide what your credit score is, and we're going to look at your term, we're going to look at your vehicle, and this is the rate you're going to pay. That's the way it works in the credit union. That's the thing that I enjoy about the credit union, because it's across the board, it's equal for everybody. When you walk in the door, if your credit score is 700, you're going to get the same rate that the next person walks in with 700. There is no the buddy system and those kind of things. And that's what's really good about credit unions to me, is that people are treated equally based on how well they perform with their credit. Now, here's one thing I'll tell you about your credit. As we talked about this, the other part is the types of credit. Are you looking at installment loans? Are you getting credit cards? What type of loans do you have? Those are the things. But one of the things I want to point out to you, you say, well, why is all this important? Well, your credit report is like trust. Okay? So think about trust for a second. And I like to define trust this way. It's a series of events over a period of time, with predicted outcome. A series of events over a period of time with predicted outcome. Think about your best friend. The reason they know things about you that somebody else doesn't know about you is because you know they're not going to tell anybody else, right? But the only way you got there with them is you spent time with them over a period of time, right? That you started to predict how they were going to act, right? And the first time they don't act the way you expect them to, what happens? The trust is broken, right? So guess what happens when you don't make your payment on your credit, or on your credit, or your loan? Your trust is broken. Your credit report is nothing more than trust for us, for you to walk in that door and say, this person is going to make these payments, they're going to kind of make payments from time to time, they're going to miss one, or they're just not going to make payments at all. We don't know you individually, necessarily. I mean, we may have a relationship with you that we know you over time, but at some point in time, we've met you, we've looked at your credit, we still don't know, even though we know you, we don't necessarily know your credit until we pull your credit, and then we find out, well, yeah, they're paying all their bills like they should, or maybe they're not paying bills like they should, or maybe they went through a tough spell 5 years ago and now things have gotten straight. So we're looking at all those things. But again, it's that series of events over a period of time with predicted outcome. Okay? The predicted outcome is that 35%. Are you going to make your payments on time? Does that make sense? So let's talk about the credit bureaus. There's actually three major credit bureaus. So you got Equifax, TransUnion, and Experian. The fourth one I have listed here is not a credit bureau as much as it's actually something set up by the U.S. government. The U.S. government allows you to get one copy of your credit report, a copy of your credit report once a year. The neat part about this is it gives you all 3 copies of your credit report if you go to the annualcreditreport.com. So you get your TransUnion, your Experian, and your Equifax all in one. A lot of people want to know what the score is. Here's what I'll tell you. Your score is not important as far as you working on your credit. Your score is going to be important on what interest rate you pay. But you need to look at your credit more as not your score, but your behaviors. If you have good behaviors, you're going to have a good score. If you have bad behavior, you have a bad score. It's pretty simple. So if you wanted to get a copy quarterly of your credit report, what I would suggest you do is use each one of these, which is free. You get 1 copy a year from them. You can use each one of these per quarter, and you can get a copy of your credit report every 3 months. Okay. I know there's a lot of things out there now with financial institutions that are giving you, updates on your credit score and those kind of things. There's a lot of places out there that I won't mention that you see online that tell you they'll give you your credit score. They don't really have your credit score. If they're not using one of these, they don't have your credit score. Okay? So if your financial institution says that we're going to give you your credit score through Equifax, we've got some program through Equifax, that's your true credit score. But there's a lot of others out there that you see on TV that advertise that we can get a copy of your credit report and we can get you your credit score. That's not actually your credit score. I've had people come in who've gotten a copy of that and there's been 50 points difference in their credit score than what their actual credit score was. And if you read the fine print at the bottom of the page, it tells you that they're just basically calculating a number based off what they think your credit score will be. So don't waste your money or your time. Okay. Again, it's about your behaviors. So what's next? We get a copy of our credit report. We want to start reviewing the accounts. What's on there? What's on our credit report? Are there things on there that shouldn't be on there? Are there companies on there that I've never done business with? We're looking for all of those things because I tell you, one of the biggest things that can hurt you when it comes to your credit is your friends and your family. A lot of the credit problems that I've seen in my experience has been through family and friends. Especially, one of the things I've seen that really prevalent is you have a family member who has bad credit because they've had bad behaviors. They can't get an apartment, they can't get their utilities cut on and those kind of things, so they tend to use their children's Social Security number because they don't have any credit. So they use that number, they pull it, and 12 months down the road, they move out of the apartment, there's a fee due on the apartment, and then it shows up on the child's credit report.
And then when they try to go, they're not able to get in unless they pay it off.
Yeah, then you're not able to get credit because basically you're showing that you've got bad credit. It's sad, but those things happen. And I'm here to tell you about those things so that you can prepare yourself to take care of those and be aware that those things can happen. Unfortunately, people do that. The good news is if you're under the age of 18 when it happens, or when it happened, you can file a dispute with the credit bureau saying that you're not responsible for that because you're not responsible for anything if you're under the age of 18 as far as finances go. Just some things that you can look out for. But we're going to look for those errors and delinquencies, the kind of things we're talking about now. We're going to contact companies that have negative credit history. Now understand this, if you made a late payment, don't call them. Okay? They're not going to fix your credit. You made a late payment, that's a bad behavior, right? Now, let's say that you sent in a payment to the financial institution and we posted it to the wrong account. 30 days later, or 45 days later, because 30 days is usually when we report the credit from one month to the next. So 45 days later, you discover that your last payment didn't get made. You knew you made it, you call us. Well, we go in and, oh yeah, we'll correct the payment, we'll get it put over to your account, but it doesn't necessarily mean that it fixed your credit report. Okay? You need to make sure that whoever's in that financial institution also fixes the late payment or the late ticker on your credit report as well. Because I've seen those kind of things happen. Those are the kind of things that you can contact them about. Got back on the screen. If you have something that's a settlement, say it's a medical bill or something that's out there, a lot of times you can settle on 50% of whatever the outstanding bill is. But when you call them, be ready to pay it. Negotiate terms with them. Make sure that when you do pay them, you get a copy of your receipt. Because once you get a copy of your receipt, what we want to do is we want to fill out a credit dispute form. At the end of every credit report that you get from one of these bureaus, there's going to be a credit dispute form. Basically, that allows you to go in and have a voice with the credit bureau because you can't call them and talk to them. You have to send in this information. You have to provide proof that you made payment, and then they're going to take those things off your credit report. Okay? If you had an error at the bank, you're going to send a letter in, get a letter from the bank, send it into the credit bureau, and make sure that it's taken off. Okay? Any questions about those? Because it's pretty simple to do, but it's a little time consuming. Okay, remember I said there's no instant gratification with your credit report. No questions? So how do we improve our credit scores? We talked earlier about 35% of your credit score is making payments on time, right? So we want to make sure we make payments on time. We want to keep our credit card balances under 50%. We discussed that. Minimize the number of inquiries. This is where we're talking about going to a dealer, maybe. And typically you don't want to have more than about 6 credit pulls a year. So you can imagine going into a dealer and then pulling your credit 5-6 times one time. And then if you decide you didn't like that vehicle and you go to another dealer, they're going to do the same thing. And instead you drive your credit score down. So how do we combat that? What do we do? What do we do to keep us from that happening, or keep that from happening?
Don't give them social security number.
Well, that's the first thing. We don't want to give them a social security number, because if you give it to them, I promise you they're going to use it. Yes, sir. Yes, sir, you get a pre-approval. So again, this is not a plug for us, but I would encourage you to go to your financial institution, talk to someone at your financial institution, decide what you can pay based on your budget, not what a car dealer tells you that you get your payment down to, and then they determine some amount of months that they can get you into that. Okay? Use your budget to determine what you can afford. Then when you come into the financial institution, you can say, I know I can afford this much. We're going to give you a rate that you're going to be prepared to go to the dealer with. You're going to know what your payment is, and you're going to know about how much you can finance to keep you within those terms. Again, we're here to help you get it financed at a lower interest rate, a lower term, which is very important, and you're very prepared when you go into the dealership that you don't have to sit in an office negotiating back and forth with somebody about what your rate and your term is going to be. So get that pre-approval. It doesn't cost anything to get one. I say that. It doesn't cost anything with us. Make sure it doesn't cost anything with anyone, with your financial institution. But I'd encourage you to get a pre-approval, because you get your credit report for one time, you know what your credit score is, and you're much more prepared when you go into a dealership. We want to avoid payday loans, title loans, and notice I say some debt consolidation loans. Why would I say some debt consolidation loans? It depends on where you're going to get it, depends on what the interest rate is, right? So if I got a 2% rate on something now, and I got a debt consolidation loan at 5%, do I want to combine that into my debt consolidation loan? No, because it's a lower interest rate, right? But if I got 8% and I can combine it to a 6%, I want to do that. So, you know, you got to be thinking about the interest rate and those kind of things to be able to combine those things in there and make sure that you're maximizing your money. So here's my favorite slide. I say it's my favorite slide because I really think it drives home what it costs to have bad credit and what it costs to have bad debt, or bad credit, excuse me. Again, this is a true story. I won't disclose the person's name, but first thing I'll ask you is would you allow a $300 past due bill to cost you basically $4,300? Would you believe it could?
Yeah.
Yeah, it can, right? And here's how it works. So the gentleman, at the time he came in, he wanted a $10,000 auto loan. We know that a $10,000 auto loan at this point is not much of a car, right? The cost of cars is going up. He wanted to finance it for 5 years, and his interest rate was going to be 17.5%. Now, when I looked at his credit report, everything on his credit was absolutely perfect. It made no sense that he had the credit score. His credit score did not go with his behaviors. Remember earlier I said it's about your behavior, not the score. Well, his credit score and his behavior didn't match. And it threw up a red flag for me because I said, wait a minute, anybody that's got this kind of credit and is maintaining the credit this way should not have this score. I had to kind of file through his credit report at the very top of one page and the very bottom of one page and the top of another page. He had a collection out. Got a split on the page. It was for a cell phone. He had gotten a cell phone. He had used the cell phone for about a week. He discovered that the service was not good in his area. He took the cell phone back in. He returned the cell phone. Told him he wanted to cancel the contract. Well, if you read your contract, you're still responsible for those payments that you would pay for that phone over that period of time. So he says to me, I said, well, you need to get this taken care of. He says, no, I'm not paying that. I'm not paying that. I said, why would you not pay this? Well, it's the principal. I mean, I took the phone back. I canceled the contract. They should honor their part of it. But he left that out there on his credit report. So this $10,000 car was going to cost him $251 a month. So when we talk about payments, that doesn't sound too bad, right? $251 a month. But look at his interest. His interest was going to cost him $5,000. That's half the price of the car. Okay. Had he not had that one item on his credit bureau, he could have got 2.99. His payment would have been $179, $180. So look at his interest now. There's a difference. part that I want to tell you about this is think about this. In 5 years, let's say he pays the car off, he want to buy another car, he never fix that on his credit report. What happens? He's going to pay those expenses again, right? What if he buys a house? Think about the difference in the cost then. Or what if he buys a car that's twice as expensive? What can you do with that extra $5,000 or $4,000? What could you be putting that on? What could you be saving for? What effect would that have on you? Again, I encourage you to put a budget together if you don't have one. Pull your credit report. Review this information. And if you have questions, seek assistance. We're here for you. We love coming in. We love doing these presentations. We can do them individually. You can call us at the office. You can set up an appointment. It's all free. There's no charge from us. That's not what we're here for. We're here to give back to our community. And we just hope you enjoy the presentation.
Thank you. That was great information. Thank you, Mr. Wilkes, for coming. I also just want to add on, don't be afraid to ask questions. The questions